Today we'll be doing section B of the part 2 syllabus, and the first of the topics which we will discuss today is risk and return. So first we'll talk about risk and then the return part. So here, what is the kind of risk are we talking about? There are two kinds, the pure risk and the speculative risk. The pure risk is nothing but the probability of something bad happening. Something bad in the sense harmful, the kind of risk what insurance companies deal with. A speculative risk is variation from the expected. So suppose you are having an average return of 9% or 10%, any variation above or below this number is the speculative risk, the variations basically. So here at the moment we'll be mainly speaking about the speculative risk, the variations in market prices, variation in interest rates, etc. Fine. So what are the different kinds of risks? The risks are many types. One is the purchasing power risk. So purchasing power risk is nothing but the inflation, the risk that money today will be able to purchase lesser goods at a later date, right? So that is the purchasing power risk. Mainly it's nothing but inflation. And next will be liquidity risk. What exactly is liquidity risk? Liquidity risk is unable to convert a particular asset into cash in a short interval of time at its market price. So when an asset cannot be liquidated without selling it at a significant discount, it is considered to have a high liquidity risk. Then you have got credit default risk. When you're talking about credit instruments, we have a credit default risk. For example, you purchase a bond and the risk that it may not pay you your principal or your interest is called a default risk or a credit default risk, right? And the risk that somebody who owes you money, owes the company money, is not going to pay or who is going to default is the default risk. The next risk would be reinvestment rate risk. So what is this all about? I can give you with an example. Suppose you purchased an asset which is getting a return of 10%. Then you sell the asset and try to purchase one more asset for the same return. The risk that you might not get the same return on a percentage basis is called a reinvestment risk, reinvestment rate risk. For example, it happens very often in callable bonds. I'll come to you in a moment for what is a callable bond, but just a brief explanation here. A callable bond is a bond which the company can call back when it wants to, at its option, at the issuer's option. So when the company is calling back the bond, he is actually repurchasing the bond or redeeming the bond from the investor and giving back cash. Suppose the bond was giving the investor a 10% return. Now the investor has got back his money before the maturity. That's very important to note. It's before the maturity. And the investor has the cash, but he doesn't have sufficient avenues to park his funds to get the same 10% return. So that is a reinvestment rate risk. Then there are political risks. Political risks are due to government policies. Maybe investment in another country is more subject to political risk, or even in the current country where the investor's home country also is subject to political risk due to change of government policies and the change of government itself. So sometimes it might so happen that the government can seize assets, which is called the expropriation, and without giving adequate compensation. So this kind of risk is a political risk. And also and also sometimes governments don't allow repatriation of earnings to the home country. Suppose it's the foreign investment and you have invested abroad, but the government in the foreign country does not allow you to repatriate your earnings to your home country. So these are all the political risks. Then there is the business risk. Business risk is nothing but variability of demand over time, demand of the product, and variability of the sales price over time, and variability of the inputs required to sell those products over time. And also the operating leverage can be considered as the business risk. Operating leverage was explained in detail in the section A, part 2 classes. Now, there is also the market risk or the systematic risk and the unsystematic risk. The systematic risk is the market risk. Why is it called systematic? Because it systematically causes all investments to go down at the same time. So it's a systematic meltdown in the market. So now that is about systematic risk. So there's nothing a person can do about market risk or systematic risk. He cannot diversify it because it is in the market, right? An example would be change in interest rates. So that is more of a systematic risk, right? Because when interest rates change, it affects all instruments and all investments, right? So that is a case of a systematic risk. Then there is the unsystematic risk, which is industry specific, pertaining to one particular industry. So it might be that the market might be falling down as a whole, but one particular industry is going up or down below the market, right? Much below what the market is going. So that might be industry specific. For example, a mining industry or a banking industry has got risks pertaining to that particular area of business. An example of unsystematic risk would be some kind of strike affecting one particular industry or one particular company. So an unsystematic risk can be diversified, but a systematic risk cannot be. So these are briefly about different types of risks that a company faces. But now I have left out one important kind of risk for our topic in discussion here, that is the interest rate risk. What exactly is interest rate risk? Interest rate risk is not just the fluctuation of interest rates. The fluctuation of or the variation of asset prices due to variation of interest rates. Now that is interest rate risk. You might find it difficult to comprehend how does change in interest rate affect asset prices. Just let me give you an example. Suppose you have got a house for sale at 60 lakhs of rupees, and suddenly interest rates go up from, let us say, 5%, just an example, 5% to 12%. So what will happen to the demand of your building which you are planning to sell? So now anybody who wants to borrow funds will think twice because the interest rates are high, and he will wonder whether he can get a return which will compensate for this interest rates, because he needs to be paying 12% on 60 lakhs. That charge, will it be equal or lesser than the rent he is going to get from it, or the income he is going to get from that asset? So he'll think twice. So the more the interest rate, the more will be his cost, and he may not go in for a investment because the cost of funds is much higher than the returns. So this way the demand for the building might go down, and the owner may have to reduce the price in order to sell the building or make it worthwhile for the investor. So this way, the higher the interest rates, the lower the asset prices become. So there is an inverse relationship here. So the higher the interest rates, the lower the asset price. Similarly, let us talk about another extreme. If the interest rates become 2%, the investor who wants to purchase the building will have a very little cost. So whatever return he gets from the building will be sufficient to cover this cost and earn an abnormal profit. The market just doesn't allow people to make abnormal profits. So automatically the building price will go up as there's more demand for the building now, as everybody wants to buy it to get a higher and abnormal return. So the building price goes up as interest rates go down. So as the building price goes up, even though the interest rates are small, it will have to be paid on a larger sum, which will make the dollar outlays higher, dollar or rupee outlays as the case may be, right? So the cost might be more and the return might now just be a normal return. So this is the way interest rates affects asset prices. The same thing holds with bonds too. Now bond giving a coupon of 5%. Now what is a bond? First let me explain the concept of a bond. Bond is an IOU issued by companies in order to raise funds. So when a company issues a bond, it's in fact borrowing from the investors at large or from the public. So when they issue, the investors pay the company money and the company has to pay the investors interest and principals at the maturity dates. So a bond will have a face value. Now let us look at an example. Suppose the face value of the bond is $1,000, which gives a coupon of 5%, and the market interest rates are 8%. Now the market price will adjust itself so as to give a return to the investor of 8%, which is equivalent to the market. So though it appears that the bond coupon is going to give less return than the market, there will be a reduction of demand for such a bond, and the issuer will be forced to reduce the prices in order to make it worthwhile for the investor. So how much will it get reduced to? A rough and dirty calculation: if you take $50 as the interest amount, which is 5% of 1,000, and divide that by the market price, it should be equal to the market rate of interest. So with a little bit of algebra, you can get what should be approximately the market price. As I told you, this is a very rough and dirty calculation. This is not exactly how bonds are valued, but it's enough to know the effect of changing interest prices on bond prices. Okay, changing interest rates on bonds prices, sorry. And now $50 which you got from the bond divided by the 8% market rate of interest should be equal to the issue price of the bond or the market price of the bond. So that's going to be 625. So since 625 is lesser than the face value, the bond is said to be selling at a discount. Let us look at it in a different way. Now, if the interest rates or coupon rates go up and it is issuing, the coupon rate is 10% and the face value is the same of 1,000, then the interest amount would be $100 divided by the market. And now let us assume the market rate to be the same, 8%. So now the bond is going to give a higher coupon than the market. So there's going to be a big demand for this bond. So prices will automatically go up, because it will go up to the extent that this 10% return will be nullified by the increase in price of the bond. So ultimately the bond prices are going to rise in order to give the investor a return equal to the market, which is 8%. So what will be the approximate price? 100 divided by market price should be equal to 8%. So with a little bit of algebra, 100 divided by 8% should be the market price or issue price, which comes to $1,250. So it's selling at a $250 premium compared to the face value. So these are the bond basics which you need to be keeping in mind. Now let us apply these concepts which we just now studied to a multiple choice question here. So question number 40, the $1,000 bond sells at 1,125. Which of the following statements are correct? First is the market rate of interest is greater than the coupon rate of interest, right? So is this right or wrong? The market rate of interest is greater than coupon rate of interest. Actually, a bond sells at a higher price when the bond is giving a higher rate than the market rate. So here it's the opposite. He says the market rate of interest is greater, which is not correct. The coupon rate will be greater, right? So 2 is correct. The coupon rate on the bond is greater than the market rate of interest. So when the bond is giving you a higher interest than the market, obviously people are going to buy it, the demand is going to increase, and also it will sell at a premium. And the third one, the coupon rate and the market rate are equal. Is this correct? Had the coupon rate and market rate been equal, the bond would have sold at its face value. And 4, the bond is selling at a premium. Obviously it's selling at a premium because it is more than 1,000. Okay, and it's a $125 premium actually. The bond sells at a discount? Obviously no, because we just decided that it's selling at a premium. So B is the right answer, that the coupon rate is greater than the market rate, and 4, the bond is selling at a premium. So this is a good question for you to just get the basics, get your basics strong. Now we'll move on to more complex question. Now let us speak about valuation of bonds. In fact, valuation of any assets theoretically would be the present value of all future cash flow. So a small write-up about what is present value and future values is given here. Let us consider the future value of $1 for a period of 2 years at 10%. What I mean here is, if you're going to keep a $1 in the bank for 2 years compounded annually at 10%, what would be the value, the future value after 2 years? So the dollar after 1 year will become $1.10 because it gets an interest of 10, and that $1.10 will again get an interest of 10%. The principal plus interest will earn an interest. So that is all about compounding. So 1.10 again gets multiplied into 1.10, and that will give us 1.21. So the future value of $1 after 2 years is going to give us 1.21. Similarly, the present value of that 1.21 today should be giving us 1. That means we need to keep 1 in the bank to get 1.21 after 2 years. So how do we calculate that? So 1 is equal to 1.10 into 1.10 is equal to 1.21. So we are multiplying actually $1 into 1.10 whole square to give us 1.21. So $1, that is the present value, will be equal to 1.21 divided by 1.10 the whole square. So that will give us 1, right? So this is it works both ways. From the future value we can calculate the present value and vice versa. So as mentioned earlier, valuing any asset theoretically is nothing but present value of all future cash flows discounted at the market rate of interest. Now we are going to apply that principle to this multiple choice question. This question says an analyst is comparing 2 bonds, each with a 2-year maturity and a face amount of $100,000. Although both bonds have a yield to maturity of 7%. Now, if they are having an yield to maturity of 7%, that should be considered as the market rate, because ultimately all bonds yield a rate which is equal to the market, right? I will come to with a detailed explanation about yield to maturity at a later point of time, but at the moment just consider that yield to maturity is nothing but market rates of interest. right? So bond A has a coupon of 6% and bond B has a coupon of 8%. So assuming that the both bonds have annual interest payments, we need to value both the bonds. Obviously, if we are going to consider yield to maturity as the market rate of interest, bond A should sell at a discount because its coupon is less than the market. So investors don't like this bond, right? To tell it very crudely, investor would not be very fond of this bond as it's giving an interest lesser than the market. So it should obviously sell at a discount to compensate for the loss of interest. So here in the question, in the choices, choice C and D are the ones which are selling bond A at a discount. So we have to be considering only that. So we can directly eliminate choices A and B because that is showing bond A selling at a premium, which is about the face value of 100,000. Now bond B is giving a coupon of 8% when the market rates are 7%. Bond B is giving a higher interest rate than the market, so it will be an investor's favorite and the prices will be up. So it should sell at a premium. So C and D again is showing bond B at a premium. So now we need to be working out the correct answer from among C and D. Since there are two answers showing a bond A at a discount and bond B at a premium. So how do we do this? As I told you, take the present values of all cash flows. The first cash flow which we are going to consider here is the principal amount of 100,000 which we will be getting after 2 years. So the present value of 7% or 7 of a dollar, present value of a dollar at 7%, discounted at 7% after 2 years will give you a discounting factor of 0.873. Now the present value factor of 0.873 multiplied by $100,000, the face value of the bond, would give us the present value in US dollars, which is 87,344. What does this mean? 87,344, if you put it in the bank now, and if that bank earns even 7% interest annually, you are going to get $100,000 after 2 years. Now there are ways of getting this present value factor of 0.873. One is to look up the present value tables, which is readily available. It will be also available to you at the exam, as well as you can have any text which would show you the present value tables. However, there are ways of calculating it in a calculator. So all what you need to do is to type in 1 divided by 1.07. You can try it out, and thereafter when you divide 1 divided by 1.07, you are going to get a factor once you press the equal signs. Press the equal sign again, it is going to give you 1 divided by 1.07 the whole square. Press the equal sign again, and you are going to get 1 divided by 1.07 whole cube, and so on. So you can get the present value of a dollar by your calculator. A 4-function calculator would do it, right? So what I do here is 1 divided by 1.07 once, I get 0.9345, and press it again, I get 0.873, which any present value table would give you for 7% at 2 years. Now I multiply this into 100,000 to give me 87,344. Right. And now the next stream of cash flows are two $6,000 payments, which is nothing but the coupon rate, which we are going to get after 1 year and at the end of second year as well. So now if we are going to take individually the present value of 6,000 which we get at the end of the first year, and the present value of the second $6,000 which we get at the end of second year, we are going to get 10,848 in total. So instead of that, 6,000 is a common, it's a one sum which we are going to get each year, right? It's a uniform cash flow. So that multiplied by the sum of the present value of the 2 years will give us the present value of an annuity, that is $1 received every year for 2 years and discounted at 7. So the sum of it, as shown on your screens, is 1.808. So 1.808 multiplied by 6,000 will give us 10,848. So now 10,848 is the present value of all interest payments. Add this to the present value of the principal amount and you have the value of the bond. Also, the present value of annuity can be done on your 4-function calculator if you have the GT function. So you calculate the present value as I shown you before. So once you have pressed the sign, equal signs twice, you are going to get the discounting factor for 2 years at 7%, and after that just press the button GT and you are going to get the present value of an annuity. It adds up the present values of year 1 discounting and year 2 discounting. So that gives you 1.808, and that you multiply by 6,000 to get 10,848. So we have done the valuation now of bond A. Now let us do the same exercise for bond B. Now bond B, the only difference here is everything remaining the same, the interest changes. The coupon rate becomes 8% instead of the previous 6%. So the present value factors are absolutely same for both the dollar received after 2 years, which is 0.873, and the annuity, that is a dollar received every year at discounted at 7% for 2 years. So that is 1.808. So 1.808 multiplied here by 8,000 is going to give you 14,464. The maturity amount remains the same as the previous question. So the present value of the maturity amount is exactly the same as the previous bond. Sorry, not question, bond. So 0.873 into 100,000 will give us 87,344, and to this we are going to add the present value of all the interest, which is 14,464, to give us 101,808. So that is the value of bond B. So we got bond A and bond B, and now the answer is, if you look at the answer, it is going to be option C. Option C is the answer because it comes closest to what the figures we have arrived. We have arrived at 98,182 and 101,808. So that's about a valuation of bonds which is paying interest annually.